different methods or different techniques available for the purpose of taking a capital expenditure decision. So what we have done, we have carried out market research, we have carried out market survey, we have carried out deep analysis of the market demand, competition and everything. And having done that, we have also prepared the projected cash flow. So taking into account the capacity, the demand, the market size, and all factors, we have prepared the projected cash flow. Now, what are the methods which are available, techniques which are available? The first technique which is available is known as payback period. So before we take a decision about a capital expenditure, we find out the payback period. What is the meaning of payback period? As I said little while ago, payback period would simply mean within how many years time we would be able to get our investment back into our pocket. Within what period we would be able to get our investment recovered from this project, and that is your payback period. So how do we calculate the payback period? A very simple case study for calculating a payback period. So here we have a project. We are making an investment of $20,000. In the first year, we are getting a cash flow of $5,000. In the second year, we are getting the cash flow of $10,000. In the third year, we are getting a cash flow of $20,000. And in the fourth year also, we are getting a cash flow of $20,000. So my question to all of you is, now that you understand what is the concept of payback period, my question to all of you is, what is the payback period in this case? Everyone, you can please unmute yourself and tell me what is the payback period.
Third year.
Third year, okay. So your payback period is falling in the third year. But can you be a little more precise and tell me as to how many years and months is going to be our payback period?
2 years and 3 months.
2 years and 3 months, and you're absolutely right. So our payback period in this case is going to be 2.25 years. 2.25 years. And why is that so? Because investment is $20,000, 55,000 recovered in the first year, 15,000 recovered in the second year. What is remaining is 5,000. In the third year, we're recovering 20,000. So 5,000 recovery of 5,000 in the third year is going to consume 3 months, and that is how our payback period is going to be 2.25 years in this case. Remember friends, in principle, shorter the payback period for a project, better it is. Shorter the payback period for a project, better it is for the business. Why? Because earlier you get your money, lesser are the uncertainty associated with that project. So lesser the uncertainty, lesser is the risk associated with that project, and that is the fundamental principle in deciding about taking any capital expenditure decision. Then something that we need to understand is known as WACC. WACC is weighted average cost of capital. Will somebody like to tell me as to what is WACC in your understanding? Anyone?